The last closing price for Krispy Kreme Inc. DNUT was $3.71 on October 22, 2025, at 4 p.m. EDT as the market is currently closed. That closing figure marked a notable intraday gain from the prior session, a swing that created a fascinating tension between the stock's recent volatility and the company's underlying strategic narrative. The immediate takeaway, the insight that might not be on everyone's radar after seeing a single-day bump in a stock that has bled value for a long time, is this: the recent spikes in DNUT, including that last positive close, are not fundamentally about donuts selling better than expected in a single quarter. They are overwhelmingly a function of technical trading forces and a massive short interest, which has made Krispy Kreme stock a kind of lightning rod for retail investors and meme stock buzz, completely disconnected from the traditional value proposition. This is the reality that challenges the common expectation that every stock movement must be tied to a news item about sales or a store opening. This recent price action is noise driven by a mechanical setup, specifically the high percentage of the public float held short, making it susceptible to rapid, outsized movements when sentiment shifts or when short sellers are forced to cover. The general belief, particularly among the newer, more retail-focused traders who might be using platforms like Robinhood Stock Trading or SoFi Invest, is that Krispy Kreme is a straightforward consumer brand play. You like the product, so the stock should go up. They see the brand recognition, they see the partnership with McDonald's, and they see a low share price, which can feel accessible, especially to those self-investing their capital. This creates an expectation of a quick, simple rebound. The deeper reality, however, is that this is a company in the middle of a very complex, capital-efficient, but execution-heavy business model pivot, and its stock is behaving less like a stable consumer staple and more like a high-beta trading instrument due to that short seller positioning. The narrative of the company is a slow, methodical expansion of points of access, but the price action is a chaotic, daily swing trading spectacle. Zooming in on the recent stock movement, the dramatic daily swings in Krispy Kreme stock have been the most compelling feature. Trading volumes have spiked disproportionate to any fundamental news, a classic hallmark of heavy institutional and retail activity battling it out. When the stock experiences a multi-percentage point move in a single day, as it has numerous times recently, it is often tied to the market sensing or actually initiating a short squeeze. Short interest has been remarkably high, suggesting a deep-seated institutional skepticism about the company's ability to execute its turnaround plan, particularly given the recent weak Q2 2025 results that featured revenue and adjusted EBITDA declines. This bearish sentiment, while logically grounded in the recent financials and the high debt load from its IPO, simultaneously creates a massive coiled spring. Any positive catalyst, even one as fleeting as a general market uptick or a mention on a social media forum, can ignite a rapid vertical ascent as short sellers scramble to close their positions. This is a very different dynamic than what drives the slow, steady progress of a stock like an Interactive Brokers trading client might favor for its stability, or what underpins the long-term growth story of an Apple stock or Nvidia stock. This DNUT trading is all about immediate leverage and technical positioning. Institutional activity shows a mixed but significant picture. On one hand, you have major players like JP Morgan downgrading the stock to underweight, citing skepticism about the turnaround plan. That's a significant vote of no confidence from a major Wall Street player, reflecting the caution that someone overseeing a Schwab Intelligent Portfolios might feel about this name. Conversely, other institutions have maintained buy ratings, and the high level of institutional ownership, around 68% of outstanding shares, means that professional investors still have a vested interest. What's crucial to understand is that the decreased positions by large firms like Vanguard Group Inc., juxtaposed with increased positions by hedge funds like Millennium Management LLC, indicates a split in conviction. Some are running for the exits, seeing the fundamental difficulties. Others, particularly those comfortable with high volatility, are viewing the company's low valuation and extreme short interest as a highly leveraged, speculative opportunity. It's a battle of fundamental value investors versus tactical, event-driven traders. Shifting to the business itself, the company's core strategy revolves around the hub-and-spoke model, which is central to understanding the long-term play. Krispy Kreme doesn't want to rely solely on its traditional, large and expensive hot light theater shops. Instead, the majority of its growth and its entire capital light thesis is centered on what they call delivered fresh daily, or DFD. This means producing the donuts in those high-volume centralized hubs, the hubs, and then delivering them to thousands of smaller, cheaper retail locations, convenience stores, grocery stores, and even the new partnership with McDonald's. These are the spokes. The goal is to dramatically increase points of access from approximately 13,000 to a long-term goal of 75,000 to 100,000. This is an elegant, high-margin logistics and brand licensing model, moving away from being a traditional retail food chain toward a wholesale food distribution company. They are not just selling donuts, they are selling a fully baked, fresh product through an efficient, wide-reaching network. This approach is what attracts interest from Fidelity Investments and other large asset managers looking for scalable models in the consumer sector, even if the current stock performance has been messy. The problem, which is the reality side of our analysis, is the execution risk and the time it takes. The DFD model has to be perfectly managed to ensure freshness and consistency across tens of thousands of locations. Supply chain issues, which have impacted many businesses, from Tesla stocks manufacturing to basic raw material suppliers, are amplified when you are distributing a perishable product with a very short shelf life. Furthermore, a major piece of their domestic growth is tied to the rollout into McDonald's locations, which is a massive but phased project. The market is impatient, especially in the wake of disappointing Q2 2025 results, which has prompted the extreme short interest. The company is trying to execute a slow, steady logistical masterpiece, while the market is demanding the quick, immediate gratification that platforms like Robinhood app and the general self-investing trend have accustomed people to. Looking ahead, the future outlook hinges entirely on execution and communication. The next major catalyst is, of course, the Q3 2025 earnings release, which is scheduled for early November. This report will be a critical checkpoint. Investors will be scrutinizing the growth in the number of points of access and the sales figures from those DFD channels, much more than the performance of the traditional hot light stores. The turnaround story demands that the new business model segments must materially offset the high corporate overhead and the debt burden. The market needs to see clear signs that the capital-light, hub-and-spoke model is not just an idea, but a profitable, fast-scaling reality. International expansion, which continues with new market entrants like Spain and Uzbekistan through franchise models, is another key opportunity, as these are truly capital-light growth levers. They're effectively licensing their brand and product, which is a much higher margin business. Risk, however, is significant. The high short interest is a double-edged sword. It offers the potential for spectacular short-term gains via a squeeze, but it also reflects a pervasive, professional belief that the stock is still fundamentally overvalued or that the company will fail to hit its financial targets. Continued negative cash flow and the need to service debt could create funding pressures if the turnaround stalls. From an online investing perspective, this is not a stock for an intelligent portfolio, which typically favors diversification and stability. It's a high-conviction, high-volatility play. A Fidelity brokerage account holder focused on mutual funds or Fidelity ETFs might avoid this name entirely due to the inherent volatility and lack of profitability. It's a single-stock, high-risk proposition best suited for the active trader. The primary opportunity here is simply the sheer magnitude of the global sweet treats market and Krispy Kreme's highly recognizable brand. If they successfully execute their shift to the DFD model, transforming into a distribution powerhouse, the stock could find a new, significantly higher valuation floor based on its scalable earnings power and dramatically increased global accessibility, from a corner convenience store to an international retailer. To that point, comment below how many shares of Krispy Kreme you currently hold, or if you think the DFD model can truly hit 100,000 points of access in the next 5 years. Your perspective helps to gauge the retail sentiment, which is a huge factor in this highly volatile stock. In wrapping up this analysis, the story of Krispy Kreme stock remains one of pronounced tension between expectation and reality. The expectation, fueled by the brand's nostalgia and recent meme stock activity, is for a quick and easy return to glory. The reality is a company executing a slow, complicated, capital-intensive logistical pivot under the immense pressure of a massive short position. The immediate price swings are technical, driven by that short squeeze potential and trading psychology, not necessarily fundamentals. For investors, the long-term success hinges on the DFD model's execution, turning those thousands of points of access into sustained, profitable sales. If the company delivers on that scalable distribution reality in the upcoming earnings reports, the stock could break out of its current volatile trading range and begin to reflect its potential as a global food